For the past 24 years, Bank Director has held our Acquire or Be Acquired conference the week before the Super Bowl in usually sunny and warm Phoenix, Arizona. From its beginnings as an M&A conference, the program has grown into the banking industry's premier event, one focused on strategic planning, financial growth opportunities, and how potential partnerships might deliver real returns. AOBA, as it's affectionately known, attracts executives and board members from across the country who take performance and the creation of franchise value very seriously. So if you couldn't make the trip this year, I'd like to review some of the important information that you missed. I'm Dominick, and as the CEO of Bank Director, I have something of a unique perspective on the ground covered at this event. In my experience, there is at least one major issue that seems to dominate the conversations at this annual event. If you were with us in 2016, I think you'd agree it was earnings and profitability. In 2017, it was all about credit quality. Specifically, it seemed that the industry's long run of superior loan performance might be coming to an end. This year, there was a lot of talk at the conference about deposits. In fact, the Federal Reserve's ongoing program of efforts to gradually raise interest rates, combined with new liquidity requirements for the largest U.S. banks that have resulted in those institutions going after consumer deposits at a level we haven't seen in years, has created a very competitive deposit market. All banks, but especially community institutions, will have to carefully manage their cost and composition of deposits as rates continue to climb in 2018. If you don't have a plan for managing your deposit base as rates rise, I'm not alone in saying now is the time to figure one out. While deposits may have been the key theme to emerge at this year's event, it was by no means the only issue addressed. To fully appreciate how and where banks might grow, consider some of the underlying dynamics that are currently driving the market. Here, I give kudos to Tom Michaud, the CEO at Keefe, Bruyette & Woods, for keying in on some fundamental issues that have a direct impact on the performance of the bank M&A market. Tom's an investment banker, and he pointed out that the banking industry continues to consolidate at a very rapid pace. As he showed, this reduction in the number of banks creates an element of scarcity that can positively impact the valuations of certain kinds of institutions. Think about this idea of scarcity for a minute. There were slightly over 18,000 banks and thrifts in the United States in 1985. Since then, the industry has embarked upon a dramatic wave of consolidation that continues to this very day. Indeed, at the end of the third quarter in 2017, the number of U.S. banks had declined to just 5,737. While the reduction in the number of banks means there are fewer banks for sale, not all banks enjoy the same prospects as acquisition candidates. Over half of the 5,000 plus banks in business today have less than $500 million in assets. As we heard at the conference, these banks may be less attractive as acquisition partners in an industry that is becoming increasingly fixated on scale. Moreover, many of these smaller banks are located in slow growth or no growth rural markets, which makes them less desirable targets for many larger acquirers. On the flip side, banks larger than $500 million in fast-growing urban markets are much sought after as acquisition partners. One of the byproducts of consolidation is the grouping of acquisition candidates into the haves and the have-nots, with very different futures ahead of them. Another important factor in the bank M&A market is the strong valuation that bank stocks have enjoyed since the 2016 presidential election. Although there was some volatility in bank stock pricing last year, bank stocks as a group have responded positively to the significant reduction in the corporate tax rate included in last year's tax bill, to the promise of financial deregulation as Congress considers separate measures in both the House and Senate, and to the appointment or nomination of new deregulation-minded heads of the federal banking agencies. While this rise in valuations has no doubt heightened the expectations of potential sellers as to the value of their franchises, it has also given acquirers a strong currency to work with, since most transactions today are all-stock deals and should help drive an increase in deal-making activity. The rise in valuations for banks with attractive growth prospects is having the expected impact on deal pricing. In his presentation on the drivers of a bank's value, Curtis Carpenter, managing director of Sheshnoff and Company Investment Banking, pointed out that there were 6 deals in the last 5 weeks of 2017 that were priced at 2 times the seller's tangible book value. Assuming the industry's valuation remains at its current level through 2018, potential sellers in strong growth markets should be in a position to demand an attractive price for their banks. And while this will drive up M&A transaction costs, many acquirers will also have a stronger currency to work with. Yet another trend that has emerged in recent years and has become an important factor in bank M&A is the emergence of what are being called regional champions. These are banks in the $5 billion to $30 billion asset range that have strong executive management and well-honed growth strategies, evidenced by their superior long-term financial performance. Many of these banks have been active acquirers in recent years and have helped drive the market to a large extent. 3 good examples include Western Alliance Bank Corporation, a $20 billion asset bank in Phoenix, Union Bankshares Corporation, a $12 billion bank in Richmond, Virginia, and Prosperity Bankshares in Houston, with $22 billion in assets. All 3 banks have enjoyed superior growth, superior profitability, and superior premiums for their stock, which has enabled them to build their growth strategies around successful M&A programs. The CEOs of all 3 participated in a panel discussion at the event where they provided insight into their strategies. Let me highlight the fastest growing bank of the 3, which is Prosperity down in Texas. Since the bank's formation in 1983, CEO Dave Zollman and his team have completed an impressive 42 acquisitions. He said that Prosperity aspires to be a top 5 bank in any market that it is in, and that he considers deposits to be more important than loans when contemplating an acquisition. So what can you expect this year if you're a potential buyer? Well, unless there is an economic shock to the banking system, which doesn't seem to be on the horizon today, potential buyers should expect the acquisition cost of banks with an attractive franchise and a solid track record of financial performance to go up. This will place greater pressure on buyers to achieve their planned cost saves or revenue enhancements in any anticipated deal to make sure it is accretive to their shareholders within 3 years or less, which is the industry standard for M&A deals. Banks that overpay for an acquisition and dilute their shareholders in the process usually suffer the consequences in the form of a lower stock price and loss of investor support, which could become an impediment to doing more deals. The decision matrix for sellers is perhaps even more complicated, and it begins with an honest assessment of your bank's growth prospects and whether now is the time to surrender your independence. If you are the director at a potential seller, this is the foundational question your board must answer when it comes to M&A. What is in the best interests of your bank shareholders, remaining independent or selling out to another bank with stronger growth prospects? If the decision is to sell, the choice of a partner is of paramount importance. The rise in valuations means that banks with attractive franchises may be able to secure a higher takeover premium than in previous years. But not all bank stocks are created equal, and sellers need carefully consider the quality of the buyer's currency and also whether there is the potential for additional valuation gains after the deal has been completed. When a bank overpays for an acquisition, the stock price of the merged entity often declines, which means the shareholders of the selling bank also see the value of their holdings decline. Oftentimes, a somewhat less aggressive takeover premium that leaves room for growth after the merger has been completed offers the seller's shareholders a better long-term return. The best M&A strategy for small banks in slower growth markets that are less attractive to most larger acquirers might be to partner up with a similarly sized bank in an in-market merger of equals. For many community banks today, earnings pressures, regulatory and compliance costs, and the continuing impact of technology equals a recurring challenge. But all is not lost. With a strong economy, a lower corporate tax rate that will be a significant boost to the industry's profitability, and the growing possibility of a more relaxed regulatory environment, the industry's outlook is a lot brighter than in past years. Time will tell if being more a bull than a bear is a smart position to take, and I'm certainly looking forward to juxtaposing what we heard this year at next year's event that takes place at the JW Marriott Phoenix Desert Ridge. Thanks for watching, and I hope to see you in Arizona or at any of our upcoming conferences in 2018.